Perfect. Maybe we'll start. So thank you, and hi to everyone. Thank you for joining us today. We are very lucky and delighted to have Bill Winters, the CEO of Standard Chartered, joining us today for a fireside chat. The format of the call, we'll just dive straight into Q&A, really. You should see a little window which has a question and answer box underneath your screen. If you would pop your questions into that, then I'll endeavor to answer them. If anything doesn't get answered, of course, come back to myself or Adnan, who's also on the call. So firstly, just thank you again, Bill, for joining us. Maybe I'll just kick off with the first question. Probably a decent starting place is COVID, Omicron. We saw what happened to the share price last week. How do you kind of think your footprint will cope with the pandemic and the recovery and the take-up? And are you still hopeful for an economic recovery in your markets, even if the Omicron variant can be contained? Sorry, you're muted, Bill.
Sorry about that. Thanks for having me. Pleasure to be here. The best guide to how I think we cope in a renewed pandemic environment is how we coped last time. Obviously, you have to look at what could be different this time around. But I think our markets have proved to be quite resilient. Africa's returned to strong growth. China, obviously, after a short spike down, recovered quickly. Hong Kong has recovered more slowly, but the buffeting from a variety of factors, starting with the protests and then finishing with national security law and concerns about how that was being implemented, and all of that have caused Hong Kong to be a bit slower. But broadly, the markets have been resilient, and no reason to think that this time would be different. In terms of our particular exposure to this variant, as of course we don't know anything more about it than anybody else does. But it doesn't strike me that it's going to be fundamentally different. We do have to reflect on the fact that the world is becoming pretty fatigued, and that could have its own independent challenges. But I don't think any more so for us than for anybody else, from what I've seen so far. So not a welcome set of developments. Obviously, the market it really didn't like this at all on Friday, but in particular didn't like it as it relates to Standard Chartered. I can't explain that divergence between our share price performance and others. I see we've clawed a little bit of it back in terms of the gap. I can't explain that either because nothing's really changed. But at the end of the day, I think this is one that we can roll through as we did last time. We've got a good high quality credit portfolio. We're embedded in markets that will continue to grow. I think independent of the pandemic. Obviously, you would look to see whether something fundamentally changes in China. Is there some reason that the zero COVID policy and strategy is less relevant with this variant than it has been in previous variants? We could all understand why it might be if it's much more contagious. But that the Chinese in particular, and obviously Hong Kong by extension, have demonstrated that they are able to control this with relatively small impact on economic activity, certainly at a national level. So I'd be quite hopeful that we could continue to evidence that kind of resilience.
Do you have any sense on that, the zero COVID policy in China, how much of an impact it's had on your revenues? And I guess, when one day, hopefully we get away from COVID, what kind of kicker that would be to your top line when China moves from a zero COVID policy to a more back to normal, really?
Well, prima facie, it's had no impact at all. I mean, we've had extremely strong results in China in 2020 and in 2021, up to and including today. So we could look at that and say, in terms of a country that's outperformed for us, zero COVID seems to have been, as a strategy, seems to have been pretty good. Obviously, the question we'll never know the answer is, how good would it have been if there hadn't been COVID, and if there hadn't been a zero COVID strategy? We won't know that, but certainly, I think that there's a risk of some sort of a disconnect between China and its neighbors, or between our colleagues outside of China and inside, because there's no cross-border travel. I mean, virtually none. And interestingly, I think certainly our Chinese clients, not internally, but the Chinese clients have been slower adopters of Zoom than many of our other clients around the world. So while there's endless opportunities to engage in panels and groups and fora and things like that, I think we are already feeling the effect of a lack of a bilateral dialogue, and that gets worse as time goes by. But But like I said, it hasn't held us back so far. And I don't think the zero COVID policy, which has been quite effective in Hong Kong, has contributed in a material way to any, we call it to a lack of the highest level of growth. Historically, Hong Kong has been one of our fastest growing markets. Now it's more middling in terms of growth. That will come back when mobility is increased. Certainly, the things like the wealth management business are impacted by the inability of mainland citizens to travel to Hong Kong. And we feel that. You feel it in insurance sales, feel it in wealth sales. Obviously, it has not prevented us from growing in Hong Kong, but we're not growing as quickly as we would. So that would be the most direct manifestation of the zero COVID policy, more in Hong Kong than in China.
Okay, that's very helpful. And just tacking on your points around, well, if you look at the business structurally, I mean, BV consumes, it consumes 30% capital, makes a much higher amount of profits than CCIB. What is it about the corporates in Asia that is so low return for your business at the moment? And what can you do to kind of drive that higher? Is it about allocating capital away from those corporates towards things like wealth, or is there something you can do to drive higher return from that corporate franchise in Asia?
Yeah, no, it's an excellent question and observation, and one that I would say we're obsessed with. And we've been obsessed with it for a while, and we've actually made really good progress. So we've significantly reduced the proportion of our corporate client base, so the CCIB client base, that's generating below cost of capital returns. But it's not at zero. As I indicated, I think as recently as the third quarter earnings presentation, that's a key area of focus for us. Now, we've been fighting a bit of a rising tide. During the pandemic, we had a pretty significant credit migration down. So relationships that were marginal to positive in terms of ROTE or EVA, ROTE relative to cost of capital, or EVA, went negative because they were downgraded. Downgraded by us and our own internal scoring mechanisms, or downgraded by rating agencies, or both. They're pretty highly correlated. So we have been fighting against the migration effect from the pandemic. But it remains a key area of focus for us. And as we fine-tuned the network model, and I'm by no means am I suggesting that we're into the point where there's diminishing returns. I think there's still a long way for us to go to optimize the value of our cross-border business. But as we've become ever more confident that we know how to deliver that package, because we're actually seeing increasing market share in key aspects of our trade, cash business, financial markets, these things are really moving in the right direction. And in fact, have largely offset the impact of lower interest rates. But we can also see what the nature of the drag is that comes from that subset of our overall relationships that are generating negative EVA, or below cost of capital returns. And we'll go after those very hard. And that's one of the things that you can expect to hear a lot more from us about from quarter to quarter, starting with our full year presentation in a couple of months' time, is exactly how we intend to tackle that remaining drag. So when we look at the returns of the cross-border business, defined as broadly or narrowly as you want, they're very good. The underlying growth is good. The competitive position is good. We don't have a scale issue in our client segments, in cash trade or financial markets. Of course, we have scale issues in other parts of our bank, or we could redefine an issue to be a scale issue if we start to look to the global investment banking income pool. But where we compete, we're a top 1, 2, or 3 player in most of the areas of our income, and virtually all of the areas of our income growth. So that we feel very good about. But there's a drag that drags down the aggregate returns for the corporate bank down below cost of capital, and that drag is clearly coming from these low returning client relationships, which we are singularly focused on. Now, the flip side of your question, or really where we started, was on the retail side. Yeah, we're generating cost of capital plus returns, getting good growth. But that business itself is as we've begun to describe it and report it, is two different businesses. Two different businesses sharing a common infrastructure or brand. There's the affluent client segment, including our private bank, which is high returning, not capital intensive, and generates consistently good growth. Volatile as market sentiment changes, but straight lines, any regression line through our quarterly income suggests that that's a high single digit, low double digit growth business, and a double digit plus return business. And then we've got the mass market, which has been zero to negative growth for much of my time at Standard Chartered, is very, very low return, and is much more capital intensive. Right? It's dominated by the credit card and personal loan segment. That one I think we're getting right. We've invested a bit in digitization. We've invested quite a bit in data analytics, and we've invested quite a bit in partnerships to originate good credit, smart credit, and also smart liabilities. And that's really beginning to kick off. So we now have a profitable mass business. We can look forward to growth in that business. It is not yet generating cost of capital plus return, so it's a drag on our aggregate CPVB return metrics. But it's not as simple as saying, well, let's just get out of the mass market, because of course it's also picking up roughly half of the fixed expense. And unfortunately, that fixed expense doesn't go away if you just decide to get out of it, if it were that easy. Rather, we need to grow out of it. And we need to grow out of it by having the investments that allow us to grow smartly. That's what we've done. I think we've got a pretty good story to tell. And I think you see that increasingly on the bottom line in the quarters to come.
That's very helpful. So if I take it then, the mass affluent retail and the corporate is kind of where there's a returns issue. On the mass affluent side, it's about scale. On the corporate side, why are the returns? I understand how you're going to get them further, and we want to get on the digital soon, but why are the returns as low as they are on that bit of the business historically, just out of interest?
Yeah, well, I think you hit on one of the areas in your first question, which is, I think implicitly in the question was, is it just too competitive in Asia? Are the returns too low? And I think there's some truth to that. I think the world is overbanked right now, but the Asian markets are particularly overbanked. The world is over liquefied, which has obviously put pressure on NIM, which directly impacts a lending heavy business or a deposit heavy business for that matter. And that corporate segment has been hit as hard as any by the NIM compression. Clearly, we've had episodic periods of decreases in trade. That I think is coming back strongly, and we saw good evidence of that as we progress through this year. Trade is coming back, and our share of trade is actually improving. But I think the bottom line is the corporate, and I'm going to distinguish between the corporate client segment and the financial institution client segment. So we're roughly 50-50 in our CCIB business, actually slightly skewed to the fixed income or financial institution business. That if I get the numbers correct, I think going back 4 or 5 years, the financial institution business was about a third of the total. Now it's closer to 60% of our total CCIB income. It tends to be much less capital intensive. It tends to be higher returning, and is growing quite nicely. And that business itself is sub-comprised of correspondent banking, so the business with banks, which has always been a strong business for Standard Chartered. I think it's been particularly strong in the post-financial crime awareness environment, because we made the investments early on to have a really good anti-money laundering and sanctions compliance infrastructure, which allows us to safely banking customers who other banks have walked away from. So I think we're recognized as very good. So that's, even though it's a mature client segment, banks, we're pretty good at it, and it's generating decent returns. Asset managers, we were very small historically. We had a small sub-custody business, which was plagued by quality problems. We've invested in the scheme of Standard Chartered, not a huge amount of money in the scheme of that business, quite a bit. We're now a high quality provider. We're absolutely a market consolidator. I won't rattle through the names of clients that we've onboarded, but we have, of all the big global custodians, all of them would consider us to be either their top partner or amongst their very top partners, dealing with the local markets where we have expertise. But we also have built out a very strong financial markets business with asset managers, which we didn't have before. We were very much a retail and bank service provider and corporate client service provider in FM. We now broadened that out to asset managers, and now I remember one very, very large asset manager who really liked Standard Chartered, liked the people that they dealt with, 5 years ago said, we like you, but you're number 17 out of 17 in operational competence. And that's the number one criteria for us, because we figured we can get the best price for it. We took that observation to heart. I think I might have mentioned that on a call 4 or 5 years ago. We've invested in that relationship. We're now a top 3 dealer, which is pretty remarkable. And we don't have a top 3 fixed income footprint, but we are a top 3 provider because our execution quality is very high, and we've broadened out our range of products. So it's to make money, you have to both be exposed to the trade and then be able to execute the trade. And thankfully, in a full range of credit products, rates, FX options, commodities, we have abilities now that we just didn't have 3 or 4 years ago. So that's probably straying from your core question. So I'll try to bring it back to home.
It's very helpful, actually. You know what I love is the digital strategy you outlined 3 or 4 weeks ago now, I guess. Within those bits of the business, the way you segmented the business is super helpful. How do you see the digital strategy kind of overlaying what you talked about? Like, where does it give you the most oomph and benefit? Is it really in the stuff where asset management, wealth management, retail, or is there corporate stuff you can do? I'd love to kind of overlap that digital strategy.
Yeah, and the digital stuff that gets the press or gets the headlines is largely focused at the mass market. So it's whether it's our digital banks in Hong Kong or Singapore or Africa, or our banking as a service model, which we've now rolled out live in Indonesia, or other things like that, are really targeted at the mass market. And the product subcomponent of that is largely credit cards and personal loans. The bigger amount of spend actually is in the corporate space, which is exactly to your points. It's electronic or digital connectivity to clients for the movement of their cash, the management of their cash balances, the management of their trade flows, the access to real-time information, the management of trade execution in FX and rates and credit products. And we've rolled out 350 fundamental enhancements to our what we call straight to bank next gen, which is our straight to bank is our branded portal for corporate treasurers, also used by financial institutions. It was cutting edge 9 or 10 years ago. It faded a bit. Subsequently, just suffered from relative underinvestment. We've been investing heavily for the past 3 years, and then accelerated heavily for the past 18 months. And the number of enhancements that are rolling out are tremendous. It's allowing us to win sort of major global cash mandates from Fortune 50 companies who didn't bank with us before, or from, for example, the tech sector, the Silicon Valley and Shenzhen and Hangzhou companies that didn't have meaningful or no relationship with Standard Chartered. We're now their primary bank in a number of emerging markets because of our digital connectivity, because we're leading edge in terms of establishing APIs with sophisticated counterparts. And obviously, APIs are the preferred form of digital connectivity. So we are building a platform. It doesn't get headlines because each one of these enhancements it's a convenience item or an access item for a corporate treasurer or a portfolio manager or an operations clerk at one of our clients. But cumulatively, it's a game changer. And the question always comes, and maybe I anticipate a question that might be in your mind or some of the others on the call. How do you compete with JP Morgan? They're spending 10 or 20 times what you are, and they're in the same business. And they are in the same business. What we've done, some of the same business, we picked the niches where we're really differentiated. So there's a table stakes or some other derogatory term for the cost of doing business, which we have to have a basic level of infrastructure support that is very good. It need not be best in class, but it's got to be very good. You need to be able to make a payment very easily with high confidence that it's going to be delivered and that you can report on the status of a problem. But where we're making these 350 enhancements that I talked about this year, and it was another 300 last year, and it'll be another 600 next year. These are areas where we're really differentiated. So it's access to local market, emerging markets for global asset managers. It's digital assets. I mean, we're bizarrely to me, we're recognized as being thought leaders in the whole space of cryptocurrencies and digital assets. So we've got a digital asset custodian, which is, we're making the headlines now for mandates that are coming in from quite sophisticated asset managers. And obviously there's a lot going on that doesn't hit the headlines. This is good stuff, but we decided we're going to be ahead of the game in digital assets and cryptocurrencies. We decided we're going to be ahead of the game, because we already are, in the local market access products. We decided that we're going to be the leaders in everything cross-border China, everything ECNY, everything RMB, everything the Hong Kong versus China, et cetera. We've enjoyed that position for quite some time, but it's a lot of it's blocking and tackling. It's participating in the payment platforms and being a leader there. It's being a leader in Bond Connect. On the retail side, it's being the first bank that signed up for the North-South Wealth Connect, et cetera, et cetera. So these are niches where we actually have an advantage, and we go for it hard. And we don't go into areas where we know we're going to have to displace JP Morgan or HSBC or somebody who's quite a bit bigger than we are, because we don't have an infinite budget. But we do have the ability to deliver in these areas where we have some identified differentiation.
And one of the questions we've got in, it kind of links to this, but the point kind of talks about your valuation at 0.4 times price to tangible book. And this is asking the question, as a management team, how do you balance up M&A making economic sense or value accretive sense, I guess, versus doing buybacks? And given all the opportunities, seeing growth and all these digital opportunities, how do you think about that trade-off? What's your IRR and what kind of time horizon do you have for that versus doing buybacks?
Yeah, I mean, first of all, there's the absolute versus the relative. The absolute is we invest in nothing that we don't think is going to generate well above cost of capital return at risk adjusted. So, and that includes client relationships or investments in technology. Doesn't not every investment we make lends itself to an IRR analysis, but we're not looking for something that generates an 11% return. Or the investment, the $2 billion that we'll spend on investments, or the $1 billion of which is strategic, and we're looking for returns well in excess of cost of capital. So we would look at any external investment through the same lens, and we'd have to be, because obviously we have less control over that than we would do over a share buyback. We know what the return is, at least from an accounting perspective, on a share buyback. To understand the real return, you also have to look at what you think happens to the price if we execute on the plan that we've got. And if we execute, as we said, our medium-term target is to get to a 10% plus return on tangible equity. I'm pretty sure, unless the world changes fundamentally, that we'll be trading above £4.28 if we generate those returns. So that obviously is a consideration in the context of share buybacks. But I've been very clear that we will look at external opportunities as we look at internal opportunities. I've been spending $1 billion of your collective money on strategic initiatives, things over which we have a choice. And we could have returned that $1 billion to shareholders. We could still return that $1 billion to shareholders. We've asked for permission not to, because we think the quality of the investments that we're making is very high. If we had an external acquisition opportunity that was similarly high, we would make that investment. So if we didn't, if we can't justify that, we won't. And if we don't have better alternatives internally, then we'll return the capital to shareholders. Always the case. I'm not sure how you define M&A, but we made some pretty important investments in the past year in partnerships. We took a stake in Neuron Credit, which is part of Advanced AI, Atome, which is you have written on about it. It's a consumer credit specialist, data-driven, operating across Asia, and we are now their partner in 11 markets in Asia. We'll be starting with products that you might euphemistically call buy now, pay later, but I think the nature of the underlying consumer product is much more substantial than that. And as part of that, we made an equity investment in the private company alongside Sequoia and GIC and others into a company that we believe in, and we believe that we can help increase the valuation of that company a lot. Do we think we're going to exceed cost of capital on that investment? Yeah, I think we're going to get a lot more than cost of capital on the investment. Could we have returned that chunk of money? I don't think we disclosed the precise amount, but it's not overwhelming, but it's noticeable for us. Could we have returned that to shareholders and bought shares back at 40 or 50 cents on the dollar? We could have, but that wasn't the best use of capital. No. I'm shedding some light on that particular transaction that I don't think we've done publicly, although it's out there, about it. But that's our framework, and that's the framework that we would apply to anything else that's in the market right now.
Last question on this. I mean, you're right. I mean, you've got certain like Mox, Nexus, the Africa Digital Bank. If the value doesn't become apparent as a group, would you consider kind of spinning them out and separate listing? I mean, to get like a 15 times EV sales valuation, for example. Is there something you would consider?
No, 15 times. I thought it was like 50 times. 50 times trailing income. No, look, I can't tell you how many copies I've gotten of the deck that's called something like the SCB transformation, blah blah blah. And I always think, somebody's got an idea for Standard Chartered Bank. Well, of course, they're talking about Siam Commercial Bank. And when I saw their and I'm sure you're all familiar with it. You've seen one of your friendly, probably not competitors. I don't think you call them a competitor, but compatriots in the research community wrote a report saying, maybe this is something we should be looking at. If there's value to be had, like real value to be had in via the financial alchemy of taking something and spinning it out or separating it, and where Andy and I have said clearly we will start is reporting that stuff separately. So you just get a sense of what the dynamics are in terms of income growth, in terms of cost growth, the amount of our shareholders' money that we're putting into things before they generate a profit. I mean, we decided it's material enough that shareholders should have that information. It wasn't material enough. In fact, even today, it's probably not material enough, either on the cost or the income side, to warrant the level of attention that we will be giving it prospectively, because it's becoming material and will become more so as we're successful. If we're not successful, it won't be material, I can tell you. If we're successful, then we're going to want to put a lot more money into it. Does it make sense to either look at external capital sources to help fund that growth at an asset level, project level? Absolutely, we already do that. And Northern Trust came in as a partner in our digital asset custody venture. We merged our payment platform with Currency Fair, renamed Zai. So, I mean, we're very happy to take capital at a private level. And obviously, the partnerships that we set up with Hong Kong Tel on the one hand, NTUC in Singapore, so Mox and our Singapore bank respectively. These are all taking capital at a project level. Should we take it at a portfolio level? Yeah, if we think that that's better value than operating at a project level, we could look at that. Do we actually spin it off to shareholders in whole or in part? I'd have to believe that the cost of a relative disconnection from the mothership, which may be a benefit if you believe that just culturally that liberates them to be super entrepreneurial and maybe operate outside the hyper-regulated environment. You look at that versus the benefits that you would get. I think if I've noticed correctly, Siam Commercial Bank got quite a stock price uplift around their restructuring, and that's an interesting data point. And I think we need to understand at what level of maturity were they executing the separation, and et cetera, et cetera. But yeah, I mean, I think we're open to anything, but it's got to be about value, not a short-term stock price pop.
Very interesting. I'm going to rip us back to the short term now, if you don't mind, on revenues. When I think about Q3, the loan growth is very good. I think 8%. Year on year in the third quarter. Just wanted to get a sense of any color on kind of the loan growth of the fourth quarter and the next kind of couple of quarters, or any kind of revenue, how the revenues look in general at the end of this year and kind of looking at next year as well.
Yeah, I would say I can't comment on specifics around the quarter, but yeah, picking up on some of the themes that I mentioned in the third quarter. I mean, the fourth quarter is typically a weaker quarter seasonally, and for all the obvious reasons. Nothing to think that this is going to be particularly different. I think it'll be very interesting to see how different people have fared on the back of some of the market volatility that we've had. We're less market sensitive than I think some of the other players in the fixed income market in particular. But I think clients are pretty fatigued at this point. So the level of activity, despite some of the volatility, is a little bit on the low side, not dramatically, just a little bit. We've had a very good few years, really, in terms of asset growth and loan growth, and it's been good, high-quality growth as well. I'd say that there's still quite a bit that needs to happen this year. We'll see whether it happens this year or into next year. The pipeline is very good. The level of activity that we see and that we have access to is very good. There's the old themes, which is I think a re-engagement in terms of capex and M&A volumes have remained reasonably high across our markets. We've actually generated some nice M&A business on the fee side ourselves. It's not a game changer in terms of our income line, but it's we're in the game for areas that we have some real relevance. And obviously we frequently get financing opportunities on the back of that. So I'd say the pipeline looks pretty good. The wealth momentum is looking good. We had a reasonable setback in China and Hong Kong, excuse me, earlier in the year at the time of the tech market meltdown, equity, the Chinese equity market contraction in general. That stabilized and is improving, and I think that's bringing sentiment back. So I feel pretty good about the momentum there. So all in all, I think as we look at the sort of the state of health of the business, it feels very good to me. And I think we had a decent first 9 months. I think we'll have a decent year. I think the momentum going into next year feels pretty good. We've got some we have made some material investments that are generating returns already. That accelerates as we go through time. So overall, I'd say I feel good about things.
Okay, and if I just think about, obviously the margin kind of did stabilize if you take out the IFRS adjustments that you had. And you mentioned it earlier. How do you think about the interplay between hopefully rising rates in the US and the kind of abundant liquidity you have? Like, are you worried that a lot of the margin upside from rising rates get eaten away by competition, or how do you think about that interplay between liquidity and rising rates?
Oh, I think rising rates would unambiguously be a helpful thing for us. We're not relying on it. Obviously, we're watching the world the same way you are, and the threats to economic growth are there. The existence of inflation is also there. And look, I'm old school on this. My personal view is it's going to be very difficult to escape this economic cycle without a bout of above inflations into the discomfort zone. But I can tell you, I'm of that generation, I think, and it may be simply an age thing. I kind of grew up in business in the 80s when that was very thematic. And I talk to my younger colleagues who, frankly, are much more day-to-day knowledgeable about this stuff than I am. And they say you're just wrong, right? I mean, transitory means transitory, and the economic slack is there. And anyway, we're not trying to call interest rates, except to the extent that we put on a nice structural hedge, which does begin to generate returns. I'm glad that we executed that hedge closer to 1.6% than 0.6%. Even though I think we got a little bit of criticism for not having executed earlier. Obviously, we would have preferred to have executed it at 3.5%, but that's water under the bridge. But that's apart from that, our sensitivity to interest rates is clear. We've been clear about that. To the extent that there's questions, and there will always be some questions, we'll be even more clear that we're not trying to hold anything back at all. But the real issue is what is the impact of economic activity and the consequent impact on interest rates? What does that do to the rest of our business? And that right now it feels like we're in a little bit of a sweet spot where I think that our underlying business could afford a meaningful but not enormous increase in interest rates without consequence. And I know there's always a lot of anxiety around what higher interest rates would do to an over-leveraged consumer economy. We're not overexposed to the over-leveraged consumer economy. This is an area where we're very light. There are concerns about sovereign states that would be unable to cope with even moderately higher short-term interest rates. I think we've got ourselves very well positioned in terms of our exposure to sovereign level and associated parastatal entities, credit exposures. Not to say there wouldn't be any stresses or strains, or that it wouldn't be inconvenient or painful for some countries locally. It would be. But I think we're pretty well positioned to deal with that in terms of our own credit portfolio, and the way that we've helped some of our clients and others have helped clients to mitigate, at least for a time and to an extent, the impact of higher rates.
That's very useful. And just thinking about that structural hedge, I mean, it could be very sizable. You've probably got over 100 billion of potential hedgeable balances when you look at your excess deposit plus your equity base, and obviously that could benefit revenues quite meaningfully. Over what time horizon should we think about the investment of that hedge and how much it could benefit revenues?
So the structural hedge relates to revenues. Sorry, relates to equity. Right? So that just to be clear in definitions, I actually wasn't too familiar with the term as a term, but that's it is a term in regulatory and accounting circles, and that relates to the equity. Now, the second opportunity that you're referring to is understanding better the duration of our liabilities. And when I arrived at the bank in the early years, the behaviorization of our liabilities suggested that much like our assets are very short term on average, that our liabilities had the behavioral characteristics of short term, i.e. The money was flighty. We have invested a lot of time, effort, and early on some money to improve the quality of those liabilities. So a deposit is still a deposit, and its impact on LCR or NSFR is the same, but the quality of that liability is very different. And as we reassess, as we now have data, and we can always question how useful the data was around the pandemic time because there have been such extraordinary liquidity events. But as we now have several years of experience with higher quality liabilities, we can, and when we look at the behavior of those liabilities, we can conclude that they have a longer duration than was the case previously. Not because we've redefined how we look at it, but because the nature of the liabilities have changed themselves. And heavy focus on generating treasury operating accounts, which are definitionally stickier. That's why the regulators give you more credit for that. So to the extent that we identify and conclude that the duration of our liabilities is longer than we've been giving ourselves credit for so far, that's an incremental opportunity to extend the duration on the asset side, right? That's not a conclusion that we've reached yet, not because we're averse to making the decision, but because we have to let the data work through, and we have to see how in a normalizing liquidity environment, so with normalizing central bank behaviors, no one thinks is normal right now, how confident are we that we've got this right? And that's, it's very impactful, not just from an economic perspective, but also from a regulatory perspective. So getting that right is key. But I can tell you that as I sit here today, the assigned liability duration is quite a bit shorter than most other banks, I think, would assume in terms of their own liabilities.
Okay, that's very interesting. And so the structural hedge on the equity of, over 45 billion, it's fully deployed now.
Well, it's deployed exactly to the extent that we wanted to deploy it at this point. And okay. I think as we indicated at the half year and at Q3, there is an element of timing to this. And we were definitely dragging our feet in terms of execution when 10-year Treasury rates got down well below 1%. And we got much more comfortable rolling into that position above 150, right? So that's just to give you a little, but exactly where we are. I'll figure out what exactly we want about that when we get to that full year.
That's very, very helpful. And then thinking about kind of just shifting tack to cost now, questions come in on operating leverage. There was a little bit, I think, of confusion on the call around whether you can generate positive operating leverage next year with or without rates. I think consensus has 3%. I mean, do you still, is positive operating leverage next year still the target for yourselves, or do you not look at the business on an operating leverage basis?
Well, I guess by operating leverage, you mean what some people would call, yeah. And I wouldn't say that it's a metric that we're obsessed with quarter to quarter, or maybe even year to year. It's definitely a measure that we're obsessed with structurally. And if for some reason we have a spurt of income growth, we are not going to loosen the expense levers, right? So that's, and we'll end up with big positive jaws that weren't in our original plan, if that's the way it works out. The flip side, if we, for whatever reason, are unable to hit our income targets, and we've been clear, certainly through the cycle, what we think those targets are. If we can't hit those income targets, then there are levers that we can pull on the expense side. And as I indicated in the Q3 call, we will do everything that we can to be positive jaws next year. Right? That's the intention. It's the expectation. Nothing in life is guaranteed because we don't know how the income picture will play out. We do have control of the expense side, and we do have levers that we can pull. So the lever that we've always resisted pulling is cutting back beyond what we do in the ordinary course on the investment program. But if for whatever reason the decrease in income appears to be more structural than transitory or a one-off, then obviously we reduce our focus on investments in addition to pulling every other lever that we can. Obviously targeted on the areas that we think are, for whatever reason, have reduced in terms of their ability to deliver income growth. So not trying to be evasive at all. Rather,
no, that makes sense. So the expectation is for positive jaws even without rate rises, but obviously if income, like we had in 2020, just gets smashed out of the blue, then what can we do? But okay, that's very helpful. And then and a couple of questions have come in just around the share price valuation. The share price has been hard to call. The third quarter results, you saw a massive decrease for not a huge what wasn't actually that spectacular set of results one way or another. How do you think about that valuation? How does it play into your thoughts about the strategy and structure of the business when you're sitting at kind of 0.4 times price to tangible book?
Yeah, well, I mean, we're constantly taking feedback from you, and our shareholders and others around what do you see as working and not working. The pretty consistent message we get from the people that have made the investment to understand us, and I fully understand that we're a complex organization, we're not that big, and lots of people just haven't made that investment. So I'd say, well, thank you and your audience right now for spending an hour and trying to understand what we're doing. But not everybody has done that. And what I hear pretty consistently is, certainly from the people that own the stock, we like the markets where you operate. Some people don't, and we're not going to change their mind if they don't like China. Then they're probably not going to own Standard Chartered. But we like the markets you operate. We like what you're doing with the business. We want to understand how you can go faster, which is, I think, a very, very fair observation. We think that your execution is pretty much on track, and you've kind of consistently hit the targets that you've set, except for those things that have been out of your control. Okay, fine. And your communication around why we should own your stock is very poor. I'm being generous, actually. I've gotten much more direct criticism than your communication is poor. And I take that, I accept that. So what we're working on right now for our full year results, and I think Andy gave a bit of a preview of this in Q3, was we recognize that our complexity and some elements of history, I'd say history being, the bank was going through a pretty fundamental restructuring up until 2018 or so. As we were gaining this sort of momentum and steadiness following that restructuring, we got hit by COVID. And you can say we got hit by disruptions in Hong Kong and US-China tensions as well. All of which impacted results to some extent, but actually the results were pretty good consistently through that. COVID, it was a different story with large impairments and the very, very negative impact of the rate decrease. So the story is complicated, and we've got to find a way to simplify the story. And perhaps simplifying the story means simplifying the business itself and narrowing our focus to some degree into the things that we really all want to own and want to drive for growth. So that's what we're working on. That's the feedback we've gotten. That there may be another school of thought that says, the markets are terrible, the strategy sucks, and you're lousy executors. If that's your view, obviously you don't own the stock. I would suggest you probably haven't looked too hard at the company or the markets either, if that's your conclusion. But of course, I'm not the one that makes that call. It's the people that make that judgment about us. So the focus from here is zero in to the greatest extent possible on those things that are going to drive the ROTE improvement over the next 1, 2, 3 years. Be very, very clear about what those are. Be very clear about what you're not going to do, to the extent that that's part of the complication, and then deliver those results.
And I'm going to sneak in one last question. When you think about that medium-term journey to 10% ROTE, of all the things we've talked about, what are the kind of 2 most important building blocks outside of interest rates, of course? When you think about it, is it digital? Yeah. Is it the tilt wealth management? What do you think?
It's managing the EVA drags, number one, and we talked in your first question about what those are, and it's supporting the underlying segments of growth, the most substantial of which is the affluent client population in the retail business. But they're extremely important segments within cash, trade, and financial markets, i.e. the network business. So,
got it. Perfect. We have run out of time. That was fantastic. Thank you very much for your time, Bill, and thank you to everyone who's joined us as well. If there were questions that we didn't answer or you wanted more detail, please come back to myself or Adnan as well, who's on the call. So thank you again, Bill, and thanks again for everyone else. Cheers.
Thank you. Bye.